That came up real quick, I just want to address,
An investing business.
the first one you asked. Oh, so I had a couple of questions about what John Burley does on lease options. He does a 10-year lease options, like I said, again, I'm not saying this is the way you have to go, but it's an idea and it works. Is a 10-year lease option, what's the purchase price? You calculate what's average appreciation over the last 20 years in that market, and you look forward 10 years, and that's the purchase price. If they exercise the option anytime, absolutely. If they stay, they stay. If they've been paying you for 10 years, do you mind if they stay longer? No. Now, why would they agree to that? Well, and they're paying usually about 10% more than rents because they're ultimately going to purchase it, is the idea. And why would they do that? If they could qualify for a loan and buy their own place, they would do that. They wouldn't be talking to you, would they? You're helping them rehabilitate, aren't you? You're giving them a second chance at a home. Okay, so that's the whole idea behind it. And B+, C-, B+ properties are ideal for that. Blue collar, husband, wife, family, family of four. A lot of your, Hispanic communities and different things like that. Really great sort, for that type of thing. The blue collar families. Because they're consistent, they're steady. When the economy goes down, they don't lose their trucking job or whatever. You know what I'm saying? Or the Circle K job or whatever it is they have. Okay? Yes. 10-year lease option, usually price it at what you anticipate the value of the property 10 years from now. Based on, average appreciation in that area over the last decade or two, right? So that's kind of how is that done. Then the second question was about well, there's something that's going along on the West Coast that's called, I just drew a blank. It's about paying off your mortgage faster.
Using a line of credit.
Velocity banking, that's what they call it.
Like a HELOC.
Yeah. Using a HELOC and those kinds of things. If you don't have any money and you have no assets, can it work? Yes. There's a cost to borrow the money, though, to do that. Right? You got to pay the interest on the HELOC. In the long run, you can get a positive arbitrage situation and it can work. But if you already have any kind of assets or income, it's not the best way to go. Okay? So it's really for those people who have no income, extra income. In other words, they're not living the 80-10-10 rule, right? And they have no assets to work with. It's a way to help them kind of get out of the hole. The problem is, why it's slower, you got a cost to borrowing the money, don't you? So if you're in that situation and you want to use velocity banking, not negative to that idea, just understand it's a long, slow process. The only thing I'm going to say to you is this. Don't pay a bunch of money for a program to show you how to do the velocity banking, because there's free programs online that do exactly the same thing. The bottom line is, if you pay more on your mortgage, you're going to pay it off faster, right? I don't care how you do it. There's all kinds of different philosophies behind it, but it doesn't matter. You pay extra on the mortgage, you're going to pay it down faster, period, right? The more you put in, the faster it's going to go. Should you, though, pay it down faster?
Yes.
No.
50-50.
Here's why. Let's say you give an extra payment. A lot of people do this. They pay an extra payments on their mortgage and knock it off and pay it off faster. I get what you're trying to accomplish. Let's say you've been making extra payments for a period of time to the lender, and then you run into a cash flow problem. You lose a job or income or something like that. Can you go to the lender and then say, hey, Mr. Banker, I've been paying you all this extra money all these years, and can I borrow some money to pay the mortgage payment? No, not only you're going to potentially lose the house, you're going to also lose all the extra payments you made all that time, right? Here, what's the issue here? Control. Who's controlling the dollars, you or the lender? Every time you give up here's another key wealth principle I want you guys to understand. It's going to tie into what we're going to talk about next. Every single time you get your hot little hands on a dollar, you don't ever give it up. Because every time you give $1 away, you trade $1 for anything. You buy a cup of coffee, you buy a house, you buy whatever, you pay extra on the mortgage. What did you do? You gave up the ability of that dollar to earn interest for you in the future, right? What is that called? Lost opportunity cost. Now, at 5% interest, if you're 50 years old, $1 will increase 5.5 times in your lifetime. If you're a 30-year-old in this room, it will increase 14 times. I actually have slides on this. I skipped it. I better go back to it. Because this is so important. In other words, if you buy a cup of coffee and it costs you $1, did that cup of coffee cost you $1 or something more than $1? If you're a 30-year-old, it costs you 14 bucks. People say you can't teach millennials anything. I totally disagree. I love working with millennials because here's why. Most of them are nice folks. Most of them I meet because of their parents. They say they need to talk to this guy. Their parents say that. And they meet me where? At the coffee shop. Which is fine. And they're mostly nice, and most of them buy, by the way. I let them. And I share this with them. And then, I will quote, they will look at the 2 cups of coffee and say, crap, I just spent $100. And I go, congratulations, you just learned lost opportunity cost. The only bad part of that story is the next time we meet, I end up having to buy. Because they learned the lesson. At least it's a tax deduction for me. You see my point? What I'm getting at is, this is a huge wealth key to understand. Every time you trade $1 for a cost, purchase an item, or pay a bill, or do anything with that dollar, you gave up the ability of that dollar to earn for you in the future. It's called, and there's a book called Acres of Diamonds, or I'm sorry, Richest Man of Babylon. That's the one that really talks about that lost opportunity cost and compound interest and all that kind of stuff. What you're really giving up when you trade. I'm not saying never buy a cup of coffee. What I'm saying is understand the true cost of that cup of coffee when you buy it. Now apply that to a car or a house or an investment property or any investment. People say, I'll say to me, how much did your house cost? Well, it cost me $400K. I said, did you get a mortgage against it? Well, yeah. It didn't cost you $400K. What did it really cost you? Anybody heard something called a truth in lending statement? On every mortgage, go to that paper and look at that number. If you pay out that mortgage over that time frame, whatever those papers were you signed, and you pay that mortgage out as agreed, that's what you paid for it. Is that real money? Yeah. By the way, on a typical mortgage, that's at least 2 to 3 times the purchase price, right? Mm-hmm. Your $400,000 house isn't $400,000. 800 to $1 million. Did you work for that money? Oh yeah. Blood, sweat, and tears, right? Okay, is the house worth $1 million? If the answer is yes, buy it. Starting to understand how wealthy people think about money, really? See, the real estate agents already know that. They just don't like telling you that. Neither does a car salesman, by the way. What does he talk about? Payments? Don't talk to me about payments. Tell me what does it cost. What's the total dollar amount if I finance this thing? Oh, you want another one? I don't know. This one may go over your head. We may have to talk about this one in the future. Whether you pay cash or finance an item. Let's say you pay cash or finance a car, which is better?
Zero interest is pretty good.
Zero interest, that's an exception. But normally speaking, should you finance a car purchase or should you pay cash? You have the money.
It depends on what you can make on your
He's
money.
getting smarter. Here's what I'm telling you, it's no different. If you can earn 5% on the money, or you have a 5% loan on the money, is there any difference? Zero.
Where you got control of the money.
You got control. The difference in dollars is exactly the same. It's about a control issue. So if you can borrow at 5 and make 5 on the money, you're in control. So therefore, should you pay the house off faster? No, you want control of the money. Especially if your interest rate on your mortgage interest rate, let's say on your house is 4.5%. Let's just say. Can you go and make 4.5% on that money? Then why if the answer is yes, then why the heck are you giving that to the lender? And giving up control of it? Make sense?
Yes.
All right. Let's get to the solution. Creating a personal bank. I got one more idea, and I promise I will show you a solution. It's really not that complicated. The last one I got to share with you is, I mentioned it earlier, now we're going to go a little depth. You have to learn how to think like a banker versus an investor. If you're going to operate a bank, a personal bank, you got to understand how banks operate. And most of you in this room do not know really how banks operate. I know I didn't. See, most investors, here's the difference. Invest hard-earned dollars for assets with the expectation the asset will increase in value. They focus, as we've talked about earlier, potential gains only, right? Creates little or no cash flow in most cases, and rarely ask what if things go wrong, right? That's typical. Now, if you purchase a stock, real estate, or a business, can you tell me what it's gonna be worth in a year? You can guess, you can look at charts, but you don't really know, do you? Now, again, this is rich dad, poor dad, this isn't me. Investing primarily for appreciation is just another form of gambling. If the only way you make money is it goes up in value, go to Vegas, have fun at least. Right? What's the difference? And yet, isn't that what almost every American does every day of their life? Hope it goes up, right? Returns uncertain, little no cash flow, no downside protection. Here's how our banker operates. How many people in this room have ever taken a mortgage or a car loan? Most of us. And when you signed the papers, you knew you'd have a payment, right? Did you plan to make those payments? Of course you did. You wouldn't have signed the papers otherwise, right? And you went through a qualification process to get the loan in the first place, right? So the banker's pretty darn sure you're gonna make those payments, aren't they? Okay, well, and if you didn't, what would have happened? They would have taken it. They would have taken that asset, sold it to somebody else, and gotten their payments, right? Is a banker really risking their money? Do you know collateralized loans almost never lose money? Almost never. You want to be a hard money lender? Not a bad way to go. What happens if you don't get paid? Take the property, sell it to somebody else. Not a bad way to make money, is it? Got no toilets to fix.
It
Either.
didn't work out in 07, 08 though.
I'm sorry?
It didn't work out in the crisis.
Well, here's the thing. It did if you had the time frame to wait, because what happened? In most cases, most banks, what did they do? They held the property, because the values had dropped, right? And in most cases, they held it long enough and waited for the market to recover and then sold it and got their money back. They had to wait a while, give you that. And that was an extreme example, let's face it. 08, 09 was a generational event, wasn't it? But guess what? Most banks didn't lose money with their real estate property as long as they held on to it long enough. By the way, to make matters worse, part of the bailout was, the Federal Reserve paid them money to hold on to those things. Most people don't know that, but that was what happened. So they got paid to hold the property because the Federal Reserve and the government didn't want them dumping it all. It would have further exacerbated the problem. That's why you had empty houses in every neighborhood in America, just about, it seems like, at least in Arizona. Okay? That's what happened. So I said almost never, I'm not saying never, but almost never, collateralized loans don't lose money because you collateralize it and get an asset that you can then take the asset, resell it, and create another cash flow from it, can't you? Or get your cash out. Am I right? Yes.
Are the cities as vigilant about the banks maintaining those vacant properties as they are with investors?
No, not at all. Because what are you going to do with Wells Fargo if they don't want to respond? Sue us. Good luck. Sucks to be you. So, yeah, they're in a better position, but even as an individual hard money lender, you're in pretty good shape, because even if you had failed, you foreclosed on the property lost value, yes, but could you then take and rent it, let's say?
Yeah,
Or whatever.
I got it, yeah. My experience has been very different to
Yeah, yeah, it
in
can
the
be.
hard money lending sense, and
Yeah.
also in the mortgage-backed
Yeah.
investments that we bought.
Right. The key is you gotta have the underlying asset, and if the underlying asset loses value, certainly you could lose value for a while, but it does come back.
Obviously, eventually.
Eventually, you just gotta have the wherewithal to be able to hold on to it long enough, okay? That should be part of your plan, like I said. Don't just look at rate of return, right? Can you weather the storm? Now, are we gonna have another 08, 09? I don't think anybody thinks that. Are we gonna have another correction? Of course, right? Yeah. So anyway, how do you create a personal bank? It's really quite simple. We get a check, what's the first thing we all do with it? Put it in the bank. Most of us don't even see it, it's direct deposited, right? Banks have sped up the process so they get your money faster. And what do the bank do? What do they do with the deposits? Loan it out, compound interest. Cars, houses, credit cards, all that, right? Now, here's what banks really, really do. Let's say you walked in the bank and you wanted to get you wanted to open an account, you gave them money. Then the next person walks in the bank and wants to get a car loan. Does the banker take the cash you just gave him, turn around, and give it to the car loan person?
No,
No, well, you read the slide.
they hypothecate it.
Yeah, most people think they do. The reality is they don't. What they do is they take your cash, stick it in the safe. Is cash an asset? Of course it is. Can you borrow against an asset? Of course you can. We do it all the time, right? Well, guess what? Banks don't invest in the stock market. Public record. Look it up. Chase, Wells Fargo, B of A, pick a name. I don't really care. None of them. What they do is they earn compound interest on their deposits. So can you. They borrow against the cash they hold, earn more interest. The more cash they have available, the more loans they can do, right? More interest they can earn. So can you. A personal bank creates an asset that's guaranteed and insured. You have access to capital day one, by the way. This is important for a lot of real estate investors. You earn interest on the asset and the borrowed funds. This is huge. I'm going to touch on that a little more. And it's tax-free, growth and withdrawals. Tax-free is pretty cool. You basically actually have 2 to 16 times more total dollars to spend doing this versus not doing this. Remember the time value money and lost opportunity cost? Okay? The tool we use is insurance. And when I say that, a lot of people are surprised. It's not that we love insurance, it's just the best tool that fits the concept. And please don't confuse the concept with the tool. We could use any financial tool for that matter. This is just the one that fits the best. And here's why. Process of elimination. Compound interest. We want an increasing cash flow. You want your money to grow every year, right? We want no risk of loss. Do you want to borrow against an asset that can lose value? No. So that takes away every financial tool that's market related, doesn't it? Right? You don't want to borrow against that? Doesn't make sense. Liquidity. CDs, some annuities have safety, but they don't have this kind of liquidity. So they're knocked off the table. We want access to funds. We don't want any penalties, age, or other restrictions, so the whole IRA 401k world just got knocked off the table. And we want tax-free growth, tax-free withdrawals, and tax-free to the heirs. In the entire financial universe, there's one product that does all of this. And by the way, it's not the kind of insurance most of you are familiar with. How many people in this room have an insurance policy on themselves or family? Anybody? Yeah. No, you don't. What you have is a death benefit protection policy. What you did, and I'm not saying that's a negative. What I'm saying is understand what you did. You've given some money to an insurance company so that in case you get hit by the ice cream truck, your heirs get a check, right? Is that life insurance? Or is that death benefit protection? That is death benefit protection. Why does the industry call it life insurance?
Sounds better.
Sounds a lot better. Do some agents try to tell you, some of these have some cash in them even, do some agents try to tell you it's an investment? Yeah. Is it? No. Because it's designed as a death benefit protection tool. Here is and by the way, some of you are going to insist on researching and going online, and you're going to find all kinds of stuff about never invest in life insurance, it's a terrible investment. And they're right. Because 99% of insurance contracts out there are designed as a death benefit protection tool. That is not an investment. Understand the difference. What I'm talking about is something called high cash value investment grade. This is something that banks, corporations, and such purchase. Not the kind that's institutional investors. Not the kind that the typical average American buys or is presented with. Yes?
That's not tied to anybody's debt.
It is.
It is.
It is tied to your, there's a death benefit associated, but here's the difference. I already talked about that. Think of a teeter-totter. 99% of insurance contracts in the United States literally are structured this way. There's low or no cash. Term has no cash, right? It is a death benefit protection tool. It's designed to protect you. And by the way, I have some of that myself. I have a family in business. I have death benefit protection needs, don't I? And some of you do too. You should have some of that. I'm not saying it's a negative thing. I'm saying know what it's for. Okay? Well, that's not what I'm talking about today, though. What I'm talking about is maximizing cash. In fact, that teeter-totter can be switched quite a bit. No, show me the money, baby. Is there a death benefit? Yes, but we're minimizing it on purpose. We're maximizing the cash. There's a wide range on how much it can be done, and by the way, the maximum limits are set by something called the Modified Endowment Contract, or MEC. Look it up, it's in the tax code. And it's been around for about 40 years. It's nothing new. Okay? So there's a limit, tax-wise, how much we can do, because here's the thing, here's the thing, understand, whenever the IRS limits something, is that usually a good thing? They limit Roths, right? How much you can put in, right? Why? It's a good thing for you, tax-free growth, right? They limit how much cash we can put into one of these things. That tells you something. Yes, you can grow tax-free, but you can only put in so much. We can only move that teeter-totter to a point. It's a wide range, just so you know, but there is a limit. We maximize that limit. That's our goal. Now, why? Another reason why you haven't been shared by this, by any insurance or financial advisor? Well, you're not talking to the right ones. They're not the 2% rock stars, or they're not the ones that are dealing with the family offices or institutional investors or on a board of a bank or something. Secondly, where do you think the commissions come from? Death benefit or cash? Let's just be logical for a minute. Is there commissions on cash? No, cash is cash. So if we reduce your death, we reduce your death benefit by 60%, we just reduced the commission by that 60%, didn't we? I make a lot less commission, as a company, we make a lot less commission per case than the average agent does. On purpose. We do a heck of a lot more business too. Because I even had agents sit at my desk when I first introduced this to them. Folks that worked for me for over a decade said, I'm not cutting my commission. I said, you're an idiot. How many people you know are going to put in 10, 20, 30, 50,000 a year for death benefit protection? There's a 1% that need that out there. Right? Very wealthy. How many people you know are going to put 10, 20, 30, 50K a year or more away to grow cash? That's a way bigger number. And there's something in our industry called the $1 million round table. It means if you sell $1 million, it's been around for over a century. If you sell $1 million of insurance in a year, you're in the top 1% of insurance agents in the world. That's a bad month for me. Okay? And I'm not even trying to sell death benefit. I'm trying to give you cash. See the difference? I'll do 10 or 12 of these in a week, especially after something like this. And that's a good year for most people in my industry. Okay? Yes, I'm making a lot less per case. So what? And I'm not charging you fees, so we all win. So that's kind of how it works. Again, I already shared this. If you own a life policy, does it have a value? So those policies that some of you raised your hand and said you had, do those have a value? To your heirs, yes, if you're gone, but to you. Will you ever see that money? Andy, will you ever see any money on your life insurance policy?
I just got rid of it actually. But
Yeah, but if you still had it, let's say? No, your wife or kids or your heirs would.
well, it's a whole policy.
Okay, well, that one may have some, but you know what I'm trying to say.
Yeah.
In most cases, the answer is no.
No, it's just.
Yeah, term,
definitely.
yeah, no. That's what's called known as a guaranteed cash contract. In other words, again, you pay them money, they're gonna pay out a death benefit when you're gone. That's a cash contract. Can you borrow against the cash contract? The answer in most cases is no. But guess what? There's a few contracts out there that exist. The answer is yes. So I'm going to share a little thought with you, and the light bulb's going to come on right now for some of you. What if you had $1 million insurance policy on you, structured like this, and let's say you could access a portion of that future death benefit today. Now that's going to be different for everybody because of age and health, but let's say you could access 50 grand of it today, or 100 grand of it today. Any ideas what you could do with that money? Could you pay some bills? Could you go buy something? Could you invest in something? Are you starting to see where it ties in with real estate investors? Hello, you're creating a self-funding, you're creating an asset. It's no different, folks, and you buy a property with some equity, and then you borrow against that equity on that property to go invest in something else, right? Can you do that? Is that called strategic debt? Is that smart debt? Is that smart, good debt? You can build wealth that way, can't you? Why not create an insurance contract? By the way, why is it better than the real estate as far as borrowing against? Can the underlying real estate you borrow against, can it ever lose value? Yeah, we saw that in 08, didn't we? What about your life insurance contract? Will that lose value? No, it's guaranteed. You have $1 million insurance contract, is it going to go less than $1 million? As long as you set it up right. No. You borrow 100 grand against it, so now it's worth 900 instead of $1 million. We're still okay, right? Is it going to go below 900? No, because they already set the price when you went through the underwriting, right? They know how long, actuaries know how long you live, right? Yes.
And amount that you borrow against, the interest rate is gonna be less than any mortgage company.
Yeah, most cases, definitely. What you do is, how do you access? You access the funds through policy loans. See, the other hang-up people get messed up on is they say, well, loans are bad. Well, in this case, loans are good. This is strategic debt. In other words, the money's coming from the future death benefit that, Eddie, you will never see. Right? Do you care? No, you'll never see that money. It's monopoly money as far as you're concerned, right? You see what I'm trying to say? Because you reduce the death benefit, not the cash, you did not remove or withdraw your cash. Therefore, your money earns compound interest the rest of your life. You have a guaranteed increasing amount of funds. And what did I say, if you're a 50-year-old, how many times would your money increase? 5.5 times, at 5%. If you're 30 in this room, 14 times. You'll have access to that 5.5 or 14 times more money in your lifetime, depending on your age, yes.
So if you're young and you have money to put into it for student loans.
Oh my gosh, absolutely. We use this with student loans. By the way, if you're a parent, you want to fund a student loan program, this is the only financial tool that doesn't go on the FAFSA form for grants and loans. I have clients who put $1 million into these, so doctor clients, and then their kids went to college and got grants and loans. Perfectly legal. It's done all the time. And it's the only financial tool that allows that. 529 plans don't. All these other things out there don't. Those are the things that the average American do. The people that don't know any better. This is what the ones do that the tax attorneys teach. Okay? I've been to tax attorney conferences. I can tell you this is what they do. This is what they teach, yes.
What happens to loan qualification for somebody who's got a huge student debt that's in this rather than a standard debt that they can see? Can they still access?
We don't care if they have debt. Yeah. This has nothing to do with your credit score or debt or anything else.
So if you had it there, it wouldn't lower your score, you'd qualify now.
Bingo.
You still have the same debt.
Yeah. Another way I see people use it, they'll access funds directly from it or indirectly. You can use this as collateral, the cash value of this as collateral against a loan to purchase real estate or something. Yes. So you can use it either directly or indirectly. And by the way, lenders love this because it's insured and guaranteed. Would they rather borrow against your brokerage account or cash value in one of these as collateral? The lender will take this in a heartbeat. This is called Tier 1 capital, if you're familiar with that. It's the safest capital, period. It's also Tier 1 capital for reserves for any bank. Average bank in the United States is about 15% of their capital reserves. The money that they invest in is here. And it's part of their Tier 1 capital requirements that they have to have through FDIC and the Federal Reserve. Banks buy this by the billions, folks. There's an entire category called BOLI, bank-owned life insurance. You can even look it up. That the general public is not even aware of. It's a multi-billion dollars a year industry. And my point is real simple. If it's good enough for the banks, it's good enough for the corporations, and any of those folks like that, why not you and I? You see what I'm trying to say? Yeah, maybe you had a 0 or 2 or 3 with their deals, what they're doing, but the principle's the same, isn't it? Just like I said with the doctors, if you make $500,000 as a doc and I save you 10% on your taxes, you're pretty happy with me, aren't you? If you make $50,000 a year and I save you 10% on your taxes, you're pretty happy with me, aren't you? Is there any difference? See what I'm saying? No. Okay? So, by the way, policy loan costs. Whenever there's a loan, there's always costs. What's the cost? It's real simple. The interest paid on the cash is the same or higher than the cost of the loan. In other words, the interest rate is charged, so the net cost for the loan is 0. It's known as what's called a wash loan. The amount you paid and what you charged, it's a wash. It's free money. That's pretty cool. I like free money, don't you? It gets better than that. There's something called positive arbitrage. So now I got to teach you one more concept. When you have one of these, you think of your money in 2 buckets. I use the green bucket and the red bucket. The green bucket is your cash bucket. The red bucket is your death benefit bucket. Whatever cash monies you contribute are then credited interest each year, right? It creates a death benefit that if you then decide to borrow against, which bucket are you going to access the funds against? Which bucket do you want to take it from?
The red one.
Bingo. You have the option. Contractually, you have the option, which is what you want. You take it from the red one. If you don't pay the loan back, they're going to charge you interest. Which bucket are they going to charge you interest against? Green or red? This is key, folks. She's right. They charge the interest on the loan on the unpaid loan balance against the red bucket.
Nice.
Now, let's walk through that a minute. This is where light bulbs will start coming on. You can set up one of these accounts, you can access funds against it, not pay it back.